Hello and welcome back. America and Israel's war on Iran has entered week 4, and we see no signs of any let up on either side. Meanwhile, on Thursday, there was bloodbath in India's stock market. The benchmark Sensex plunged nearly 2,500 points. Nifty 50 was down close to 800 points. Almost 15 lakh crore rupees in investor wealth got wiped out. Many are wondering if the worst is over. Perhaps not. In this edition of Tracking Trends, I explore and argue why Thursday's market crash was just a trailer. More pain might be coming India's way. Before we do that, my request, as always, if you haven't subscribed to our channel, do so right away. For more in-depth analysis on the subject, do look up www.basispointinsight.com. Now let's recap what happened on Thursday. As I said earlier, Sensex crashed 2,497 points. Nifty 50, 776 points. This is the single biggest fall since 2024 parliamentary elections results day, when Narendra Modi, National Democratic Alliance, lost its majority in parliament. Almost 15 lakh crore got wiped out in terms of market cap in Thursday's crash. And the trigger was quite obvious. The crash was preceded by an intensification of fights in the Middle East. Brent crude, which is what India imports, hit almost $120 a barrel. And that made it evident that India's energy sector, India's energy companies are not going to be holding out against this crisis for a very long time. Markets across the world fell on Thursday, but India's fall was much sharper because there was another reason. HDFC Bank. The non executive chairman of HDFC Bank, Atanu Chakrabarti, quit, citing internal conduct that he said were in conflict with his personal values and ethics. HDFC Banks accounts for almost 11% weight in the Nifty 50 index. So, the impact of the plunge or the fall in HDFC Bank shares, almost 5%, were visible. But it was, even if we take out HDFC Bank shares impact, what could be seen in Thursday's market crash that it cut across all centers, which only underscores how the realization that the conflict in the Middle East, its subsequent impact on oil and gas supplies and prices, have got far-reaching consequences for India because of its huge dependency on imported oil and gas. The fall cut across all sectors: information technology, metals, pharma, banks, realty, FMCG, auto, you name it. Every sector ended in the red. Is it going to change soon? Well, on Friday, you saw there was a bit of a bounce back. But what was the bounce? Against the 3.3% fall on Thursday, market recovered just about 0.4%. This is the pattern I suspect is going to prevail for a long time to come. There will be days when there will be some positive news, there will be some hope of an end to the conflict, and you will see market responding with a bounce. But then there will be a spate of bad news, and we have seen it. On Friday, US President Donald Trump said he wants to wind down the war. Even as he was saying, and even as Iran's leadership was responding, saying they don't believe Trump's claim, It's the latest fear that turned out to be true. Israel attacked another nuclear facility of Iran. Iran, meanwhile, perhaps tested its capacity to strike long distance targets with its missiles. It fired two missiles at Diego Garcia, which is an American British controlled island, where they have a huge military base. If you remember, in the Afghan war, B 52 stealth bombers flew in from Diego Garcia, which is a little below Mauritius in the Indian Ocean, but it's about roughly 3,500 kilometers away from Iran. The missiles didn't hit the target, but Iran was clearly testing its capability to hit long distance targets. What do all these things say? They only say that no matter the statements that are coming out from time to time, raising hopes that there may be a resolution to the conflict, but a resolution of the conflict in reality appears at this point in time, an early resolution appears elusive. So long as that is the case, you will see some days the market will bounce back, but it will fall even bigger. In fact, Morgan Stanley has already released a report saying Asian markets, particularly, are more vulnerable to what is happening in the Middle East. In fact, the data bears it out. Since the time the conflict began, if you take Thursday as the cutoff, the American stock market, the Dow Jones, had fallen about 3.7%. Compared to that, look at the Asian benchmark index that had fallen almost double that level, 7.6%. And within Asia, India was worse. India's stock market, Nifty 50, has slipped almost 8.6% from the start of the war up until Thursday. We will talk about it more, why India is more vulnerable than any other large economy in the world to the crisis that is in the Middle East. But for now, what we can say that we see no early resolution to the closure of Strait of Hormuz. And why Strait of Hormuz is so critical, we have explained it in our past videos. We will do so as we go along in this conversation further. But for now, let's, from the financial sector, let's turn our focus to the real sector. Because when I said more pain is coming India's way, it is the war's impact that is making its way through various economic channels. And we are just about a few weeks away from the earnings season. And when by mid April, companies start presenting their quarterly results, uh, the war's impact would not be seen so much in the January March figures, but the commentaries will be watched out for as to how the companies are tackling the challenge, how they are grappling with the problems, because the problems are huge and multifaceted. And we intend to do that for a few select sectors today. What we are already seeing that from FMCG to airlines, from fertilizer to plastics, from manufacturing to services, the impact has beginning to show up. And the longer this conflict drags on, the worse will be the impact. And sooner or later, the stock market would start responding. As of now, it has been a sentimental play. In the days to come, it will be a play on how the real economy is actually dealing with this challenge. Now, let's take one after another sector to see how things are actually panning out. Now, let's start with the automotive sector. This is, I wanted to start with the automotive sector because this is a sector which had really turned around. It was really holding out hopes. We have done episodes on that also as to how the revival in auto sales have gone beyond the impact months of the GST rate cuts, showing demand is more structured now, and almost every segment of the automobile sector was throwing up very impressive double digit figures. And this is when the war breaks out in Iran, a real party pooper. How does the automobile sector get impacted? We've just seen the impact of the gas scarcity. There is more. But for now, let's see how the LPG and LNG gas shortage is already beginning to affect. There's major automakers, Maruti Suzuki, Tata, Mahindra and Mahindra, all of them have said that their operations have been disrupted because of the fuel shortages. In fact, some companies like Kirloskar Ferrous, Hindalco, which supply critical raw materials. Aluminium is something that is widely used in the automobile sector. Various auto components that are sourced. I'm just given two companies which were the first ones to make it public that they are stopping production because of shortage of gas, and more would have followed suit. Meanwhile, S&P Global, which encouraged by the uptake in auto sales over the last few months, had predicted a very healthy 7.4% growth, production growth in 2026, has slashed the projection now to 6.3%. Going forward, if this conflict tracks on, it could be worse. Now, automobile sector, as you know, has a lot of externalities. If the automobile sector is doing, there are several other sectors which also get a bump up. And what is worrying is that this is a sector which was really looking up, and we are pinning hopes of a manufacturing revival on the revival of the auto sector, and that seems to have been greatly affected. Now, as I said, it's not just the auto sector. Every sector is getting impacted. The other sector where the impact is significant is the petrochemical sector, because most of the inputs that go into making petrochemical products, or most of the petrochemical products that are used as inputs in various industries, uh, those come from the Middle East. And oil is an essential raw material for all of these things. Many petrochemicals are byproducts of the oil industry. Now, look at what has happened. Take the example of something like maleic anhydride. Prices have gone up 61%. Ethylene prices have gone up 35%. Acrylic acid prices have gone up 30%. If you take who are getting affected, automotive sectors is getting affected, because many of these things also make their way into manufacturing of paints, uh, other adhesives that are used in the automobile sector. The same holds for construction. Uh, Textiles is affected big way. As the graphic shows, synthetic polyester prices have already increased 15%. Petrochemical linked dyes are now 50% costlier than before. But here is the worst part: the packaging, particularly plastic packaging. There has been a huge escalation in those costs. And a hike in packaging costs affects a wide range of uh, industries, particularly and more importantly, what affects the common man, which is the FMCG sector. If we look at FMCG sector, the expectation, or rather the assessment, is that there could be an 8 to 15% increase in operating costs. So what it means that everything you buy, from your daily consumption items, like bread, biscuits, uh, cosmetics, toiletries, everything. The packaging costs go up significantly. The input costs go up significantly. For instance, PET chips, those costs are rising. Liquid paraffin, which is an important input into many FMCG products. Uh, you take palm oil, which is a major consumption item. You take lab, which is linear alkyl benzene. It's an important, most crucial input in the manufacturing of detergents. Your surf, Ariel packets are now going to be expensive. Apart from the fact that their packaging cost is going to increase, there is also a rise in input cost. Now, what happens when this happens? And which are the companies that are going to be affected? There is an assessment. This is an assessment done by Dam Capital. So for some of the leading manufacturing companies like Tata Consumer, Marico, Hindustan Unilever, uh, if the crude price averages about $85, you could see prices of their products going up by 3 to 3.5 percentage point. But should the conflict prolong and crude price average around $100, the increase in prices of these products could range from 5% points to 6 or 6.5% points. Now, who could be even a bigger loser, apart from the fact that the consumers will have to pay more? Who else could be paying more for this? It's the informal producer of FMCG goods. Because the big companies that I have mentioned here, they have enough capacity or some capacity, reasonable capacity to absorb the shock. They may hold onto their current price line in order to gain market share. But smaller producers, the unorganized sector producers, the informal sector producers of FMCG goods, be it detergents, be it packaged food products, be it toiletries, they cannot hold on for long. So they will immediately increase their prices. And because the organized and larger companies perhaps can hold on to price lines for a longer time because they have got deep pockets, it would basically mean informal sector producers would be left non-competitive in the market and therefore could lose market share, which means uh, in the longer run, you would see the share of the informal sector going down further. And look at the irony. Every crisis, some which were beyond our control, some which were created by us, starting from demonetization to GST and unplanned GST rollout to COVID pandemic, which was big, the informal sector is hopping from one crisis to another. Its size is shrinking, its is shrinking, organized players are becoming bigger and stronger, and this has got significant implications for the political economy of India going forward because informal sector generates employment for as many as 3 times people than the organized sector. Its share shrinking in the overall pie is not a very good development or a very good news to consider. Having said that, let's try and look at how these sectoral impacts are going to add up into a larger macro impact. Well, we forgot to talk about one more critical sector. In fact, the sector which is already feeling the pinch of what is happening in the Middle East. it's the fertilizer industry. And it's important because what happens to the availability of fertilizers and fertilizer prices affects our agriculture sector, our farmers, not only their well-being, but also food prices. And that's going to have probably one of the most significant outcome on macroeconomic numbers. So this is what is happening in the fertilizer industry. The gas shortage has already forced several urea plants in India, especially across North India, Eastern India, and Western India, to shut down a good part of their operations. As of a report last week, urea plants were in across India, except South India, were operating at 60% capacity. Global urea prices have surged from $475 per ton in early February to almost $600 per ton in March. That's a 26% surge, and largely caused by supply disruptions because of the closure of Strait of Hormuz. We will talk about the dependency on Strait of Hormuz very soon. But what's the downside to it? As of now, the country has enough fertilizer stocks. Uh, we, if we take the most important fertilizers for our agriculture, urea, compared to 4.9 million ton around this time last year, we have 5.5 million ton. Uh, DAP compared to 1.3 million ton, we have 2.5 million ton. NPK compared to 3.2 million ton, we have 5.4 million ton. And SSP, we have got 3.2 million ton as of now, compared to 2.2 million ton a year ago. This means that immediately there is no risk of fertilizer supply when the Kharif season starts. But fertilizer plants need to produce in these few months enough to meet the demand, the spike in the demand that will come once the fertilizer season ensues. What are the companies doing? What we hear, many companies, many manufacturers of fertilizers have advanced their annual maintenance from April to March. Now, if the conflict nears an end or is resolved in about even a month's time, we can say we will be okay. If it drags on further, then there is problem, particularly in certain areas like DAP where we are import dependent. Urea is where we manufacture enough of it here. DAP, we are dependent on imports from other countries. And one of the major suppliers here is China. And what China has done, China has put a ban on DAP exports. If the conflict prolongs, the Chinese ban on DAP stays, that will have a direct bearing on DAP prices. And we will have to bear that. The farmers may not immediately have to pay higher for fertilizer because the government subsidizes fertilizer sales, but definitely it will dent the government's fiscal position. The government's fertilizer subsidy will see a spike, and that has implications for fiscal deficit, which in turn has implications for overall interest rates and macroeconomic fundamentals. But prices apart, what if there is shortage? What if there is shortage? If there is shortage, then clearly it has a bearing on our agricultural output in time to come. And remember, over the last few years, agriculture has been doing well, and agriculture has been really cushioning against sluggish manufacturing growth, and which is why the broader economy still shows up reasonably impressive growth numbers despite a sluggish manufacturing sector. We have talked about the impact on the manufacturing sector. On top of that, if agricultural sector turns sluggish, then we had it. The hopes of a 7.5% growth in the coming year, going by the government's own estimates, those hopes will begin to fade, and that has a bearing on the sentiments in the market and where the market will head from here. Now let's come back to what we were going to address. What are the larger macroeconomic implications of the crisis in the Middle East? Now, why India is more vulnerable than any other large economy in the world? The answer lies in our dependency on imported oil and gas. As this graphic shows, India's India's total consumption of LNG, 26.5% are imported. 21% of LPG is imported. Sorry, correct. Out of 54.4 million ton, 26.5 million ton LNG is imported, which means almost 50% of LNG we import. We import almost 68% of the LPG we consume, and we import almost 87% of oil that we consume. Of this, the share of Strait of Hormuz in case of LNG is 60%, in case of LPG is 90%, and in case of oil is 54%, which is why an early resolution to the closure of Strait of Hormuz is so important for India. Not just for India, for the rest of Asia, because because the 20%, a fifth of world's oil and gas supplies move through the Strait of Hormuz. And of that, 80% are headed to various Asian countries. China is critically dependent, Japan is critically dependent. But the difference between China, Japan on one hand, and India is this. China, over a period of time, has figured out that it has to cut its dependency on fossil fuel. It has moved big time onto electric vehicles. It has invested in securing oil and gas supplies in different parts of the world. It has brought about many energy efficiency measures within its economy, as a result of which its dependency on fossil fuel imports has been reduced to less than 50%. In case of Japan, it has gone even a step further. But in India, despite all the talk we have been doing to switch over to alternative energies, our dependency on traditional supplies of oil and gas remains, if not in some cases, it has gone up in recent years. In fact, if we look at oil, there was a time when we were importing only 80% of our oil needs. Now we are importing almost more than 85%. So that's where probably our failure to prepare over the long term for such eventualities is now costing us heavy. Now, interestingly, look at how this is affecting our macroeconomic assumptions as well. The State Bank of India's research unit, its group economic advisor Soumyakanti Ghosh, in fact brought out a report. I think the report came out sometime in January, where it actually said that India is currently paying between $60 to $65 per barrel, and it said we expect this price to go down in the future to almost $54 a barrel. And it went on to further say that this 14% correction in India's basket of imported crude in Q4 could put downward pressure on our inflation rate, and our inflation rate could actually come below 3.4%. It also argued that the rupee, which has been under pressure, could benefit from this development. And in January, the rupee was hovering around 90 rupees to a dollar. The SBI research team predicted that it could actually recover to somewhere 87.5 per dollar. Now look at it. Come March, all these assumptions have gone haywire. So have the assumptions of the Indian budget, which also had factored in roughly about a $65 a barrel rate for imported crude. So what's happening on the inflation front? We have talked about all the sectoral picture, where we have shown how the war's impact is making its way through various economic channels, pushing up prices of almost all kinds of goods and services, starting from essential goods to items of aspirational consumption like automobiles. Now, if this conflict prolongs, it's going to get worse. In February, we saw that the consumer price based inflation already had started going up. We saw a big spike to 3.47%, driven largely by food prices. Now, in March, you will see that pressure continuing and inflation picking up as we go along. How far will inflation go? If you take RBI's analysis, every $10 per barrel increase leads to 0.3 to 0.4% spike in the inflation rate. Now, there are a few scenarios that we have worked out, and that is what is likely to happen in time to come. Take a look at this. Now, if we say oil price, the conflict comes to an end soon, de-escalation begins to happen in a week or two, then perhaps Brent crude prices will start easing, and we end up with a Brent crude price for FY 26-27 averaging around $90 per barrel. That's if it kind of stays range bound between $90 to $120 per barrel. That's our first scenario, which we say then it will be quite manageable. There will be certain impact on inflation. Inflation could get closer to 4%. Current account deficit, which is the gap between what India earns from the rest of the world and what India has to pay to the rest of the world for the goods and services that it imports. That could go up to 2%. The ideal limit is around 1.5%, but that's manageable. But should this conflict take a little longer to get resolved, and we end up with, because as we said, many of the countries have shut down their oil and gas production. Now, when you shut down oil and gas production, you just can't switch them on. They can take from a couple of weeks to months to come back to full swing. So the longer the conflict drags, the more intensified it gets, the more plants that get shut down in the Gulf, then you end up in a scenario where you have crude price averaging anything between $110 a barrel to $140. That's the second scenario where you start feeling the material stress. Inflation can spike up to 1.5%. In other words, it could cross 5%, and current account deficit will reach 3%, which is an alarming level. That said, the last scenario, the worst case scenario, where crude prices, the conflict continues in some form or the other, permanent peace doesn't return to the region for a good amount of time to come, you have crude oil prices touching or staying or averaging around $140 a barrel, your GDP is bound to take a massive hit of 2 percentage point. We could be seeing 26, 27, where GDP growth, by the way, according to the government's own way of calculating, could come down to 5%. And inflation, which is what everybody should be worrying about, is likely to go up by at least 3 percentage points, which means you will have an inflation way above 6%. And current account deficit would exceed the sustainable level of 3% of GDP, which means India would be vulnerable to a serious macroeconomic crisis. That is all for today. If you have liked our video, please share it with your peers and friends. Keep coming back to us. See you soon. Thank you.